going to help us understand a lot of important issues relating to what we're looking at. We are going to consider one of the most important standards. It's a very examinable standard, both in advanced financial reporting, advanced audit, and financial reporting. So it's the same. So I hope that you enjoy yourselves as I take you through this one. So guys, there we go. This is IS number 37, provisions. Now, with me here, I have the latest updates from the, from the ISP website. It's about provisions. So what I'm going to do this evening, I want us to just look at IS number 37 from the perspective of, a financial accountant. As accountants, we have the responsibility to provide information that is relevant to the users of financial statements. So our job is one that is held in high regard by the public. In advanced audit, there's something called expectation gap. What people think we do versus what we actually do as accountants. There's a very big difference. Some people think we do magic. That's not what we do. So tonight's session is going to help you see how this standard is such a very beautiful standard, but also it just gives you an insight into the Lusambo way. All right. Everybody talks about the Lusambo way. So here is a formula that I've invented. It's called the ARM. This is a formula that we use on every single standard. It works on every standard. This formula is meant for someone who's going to write an exam. So the reason why I focus on these three things, because this is what the examiner examines, the ARM. The A is the about, the R is the recognition criteria, the M is the measurement. If you can know these three things on every standard, man, you're done. Because these are the things the examiner is going to examine you on. What is the standard about? So that you can advise properly. What are the recognition criteria? So that you can be able to know if they've done the right thing or not. What are the measurement numbers? Where do you put what in the financial statement? So extremely, extremely important. So use this formula whenever you're doing standards. Just write it somewhere, ARM, about, recognition, and measurement. And good behavior tells us that we can even use, of course, we can use disclosures at the end. Yeah. So now let's use my formula here to understand this particular standard. Let's use the ARM. Okay, since we are saying that the ARM, of course, we're saying the ARM is about the about, the criteria, the measurement. So what is IS number 37 about? And the thing is that, why are we even doing what IS number 37? IS number 37, guys, is about provisions, about contingent assets, it's about contingent liabilities, and it's about sufficient disclosures. So that's what the standard is about. So the question that I get to be asked more often than not, but why do we do IS number 37? That's what you, the student, must be able to understand before exam day. Guys, you must see here that financial statements must include all information necessary for the understanding of an entity's financial position. So in order for us to understand financial statements properly, IS number 37 must be done. Do you know why? Because IS number 37 looks at, contingent liabilities, contingent assets, provisions. All these are estimates. If these things are not properly accounted for, we may end up misleading the users of financial statements. So we are saying that because financial statements include all the information necessary for the understanding of our financial position, it's important that we do IS number 37. So how does IS number 37 achieve this purpose of ensuring that all the information that is necessary is included in the financial statements? IS number 37 ensures that appropriate recognition criteria and proper basis of measurement are applied to number 1, provisions, number 2, contingent assets, number 3, contingent liabilities, and of course, number 4, disclosure notes. So the standard's main aim is simply to ensure that when Brenda is preparing her financial statements. She applies the appropriate recognition criteria and, of course, proper basis of measurement to these things, provisions, contingent assets, and contingent liabilities. But because sometimes we are human beings, accountants are people, you may be tempted, to want to look good, and then you begin to do creative accounting. So these rules act as a guide for you to do the right thing. So this is the idea why we're looking at ICE number 37. Such a beautiful standard, guys. It's a beautiful, beautiful standard. Now, let's get into the work. So we've established why we need to do standard, right? We've now established how this standard ensure that all the information necessary for the understanding of our net financial position is included. It ensures that appropriate base of recognition criteria and measurement are applied to provisions, contingent assets, liability, and disclosures. So the question is, what is a provision? That's the question that we must answer now. What is a provision? What is a provision? Well, a provision, guys, is a liability of uncertain amount and timing. So, in that statement, there's this word, a provision is a liability. So you may be thinking, and again, you say, what's the liability? A liability is a present obligation of an entity to transfer economic benefits to another entity due to past economic events. That's how we understand a liability. So the question therefore comes and says, so does that mean every liability is a provision? Because we are being told here that a provision is a liability. And now we've defined the liability as a present obligation of an entity to transfer economic benefits to another entity due to past economic events. So now, guys, what I want us to understand from this definition, there are two very important things here. Number one, we've been told that a liability is a present obligation. That's extremely important. And then number two, we have been told it's an obligation to transfer economic benefits. Another very important statement. So there's of course, there's there's a transfer economic benefits, but also there's this guy here, which is simply of course, the present obligation. So what is a present obligation? So that's what we want to be thinking about here. A present obligation, guys, comes into two categories. It could either be legal or it could either be constructive. Okay, let's see that we have somebody in the waiting room. We have a lot of people in the waiting room. Really? I didn't see these guys here. We have 3 people in the waiting room. Okay. Fantastic. 1, 2, 3, 4, 5, 6, 7, 8. Wait. Okay, fine. Let's go. Guys, so there we go. So we're saying a present obligation could either be legal or it could be constructive. When we say legal, it means you are required by law, right? Sometimes you may have been sued by your client, you're required by law to compensate them, all right? That's a legal requirement. So here, when you are being sued by your client, you're going to make an estimate of what is going to cost you in an event that you lose the case. That estimate is what we refer to as a provision. Now, a provision is different from other estimates. A provision is a probability of more than 50% chance that you're going to lose the case. If today, right now, as we are discussing here, right now we're discussing, and then Brenda tells Melinda, you owe me money. If you don't pay me the money that you owe me by Friday, I'm going to take you to court. What has happened here is that Brenda has issued a threat to Melinda. So Melinda's liability is dependent upon her behavior. If Melinda pays Brenda her money before Friday, then there will be no court issues. So what is there when somebody threatens you? What you have is a contingent liability. It's dependent upon the future outcome. For a provision, it's different. If Brenda threatens to sue Melinda by Friday if they don't pay her money, And Friday comes, Melinda does not pay the money. Brenda now goes to court to sue. Now what we have is a provision. It's no longer a threat because now it's in court. So because it is in court, we have to ask our lawyer, dear lawyer, do you think we're going to lose this case? If we lose, what is the likely amount we are likely to pay? So if there's a probability of 50%, that means we can now recognize a provision. And now we make an estimate based on legal advice from our lawyer. Say, hey guys, you're going to incur maybe 20,000 kwacha for this issue. We're going to incur 50,000 kwacha for this issue. Then what do? We record a 50,000 kwacha. Now, this is where auditing makes sense. If this was advanced audit, what we could have been talking about now would have been a bit more different. We could have been talking about IS number 10 also. Okay. Thank you so much. Bye-bye. Really? Okay. Yeah. It's rough, guys. So there we go. So what we have, this boy just came to kiss me. Can you believe that? So there we go. So what we have now here is an estimate. So an estimate is 50% and above. And how do you estimate? You ask your lawyer. You don't put an amount because you like it. You have to consult with your attorney and find out, okay, fine, how much is this likely to cost us? Okay, and then that way it's going to be able to help. Okay, so let's move on. So remember, guys, we're still talking about the first one. We're still talking about a provision. We're saying, what is a provision? So we're still discussing a provision at this point. It's a liability of an certain amount in time. What's a liability? A liability could be a present obligation to transfer economic benefits to another entity due to past economic events. And we've said the word there, the statement there, present obligation could either be legal or it could be constructive. There's some feedback from somewhere. Please, guys, mute your speakers. We are getting some feedback from one of you. That's Mr. Masheke. Mr. Masheke, please mute yourself. Let me just mute Mr. Masheke. Okay, fantastic. I've managed to mute him. All right, fantastic. So there we go. So that's what we're talking about. We're still talking about a provision. We said it's a liability to define the liability. Now we've explained the statement and liability vision present obligation. It could be legal or constructive. What do we mean when we say constructive? By constructive, what we mean is different. Remember, legal, you have no choice. You've been sued. Okay. Constructive here is different because it's subjective. If you have a boy from the neighbor whom you send, right, every day to go and buy for you whatever they buy for at the market. When every time they go, you give them 100 kwacha. Every time they go, you give them 100 kwacha. What that means, it means that you are creating a constructive obligation with this particular boy because according to them, they believe reasonably that every time you send them, they're going to make 100 kwacha from you. So if it happens that you send them the fourth time and then you give them 50 kwacha, they can usually say, no, you're cheaper, give me 100 kwacha. You can't say, no, I just give you 100 kwacha because I feel sorry for you, no, or because I'm nice, no. It's a constructive obligation. You know, some years back I had ladies, I usually talk about these ladies. They used to live in Lusaka West. These ladies would hire me over the weekend to go to Lusaka West to, take them through some preparation for the exam. And every weekend when I go to these ladies, I would come back on a Monday with a 4.5. Every weekend when I go, I would come back with a 4.5. So according to me, I was made to reasonably believe that every time I go for a weekend, I'm going to come back with 4,500 kwacha. We did not sign anywhere. There was no documentation. But every time I went to lecture these ladies, they gave me 4.5. So they made me believe that my services to them are worth 4,500 kwacha. Even though I did not charge them, they charged themselves. They were giving me 4.5 on their own. Right? That's a constructive obligation. It is implied. It is due to your past dealings or your conduct, where you make someone to reasonably believe that you honor the part of your bargain. It's like somebody, there are some relationships you don't have to propose. Fiamba fefi ne fi automatic fi. But no one has proposed to who. There are such kind of relationship where people just fiamba fi quite fair. Things are happening, but no one has proposed because of the conduct. At the case where I then came, one of my students was telling me that no, the fiance, the man she was seeing, who was also my student, decided to change his mind that he was not going to marry her. He said he did not propose. So I was telling you, you're an accountant, you've done accounts, you've done IS number 37. When you say you did not propose, but you've been buying assets for the house together. Can you believe that you go to buy sofas with a lady and then you say, no, I did not propose, but you're buying sofas together? She's contributing when to go and buy sofas. You go and buy a microwave, you go and buy freezers and nice beds together. What do you mean you not propose? So by implied, the lady believes that, okay, this man likes me. That's why we are buying things together. You don't have to propose. So it's a constructive obligation due to your past dealings or your conduct. So you have to be very much careful how you behave if you are dealing with clients, because you may end up having a constructive obligation. So that's what we mean by, legal obligation and constructive obligation. So now if you think about it, guys, does that therefore mean that every liability is a provision? The answer is a categorical no. It's not every liability which is a provision, all right? It is not every liability which is a provision. Like we are saying here, what we are simply saying here is that a provision is a liability of uncertain amount and timing. So for a provision, you do not know exactly how much money you're going to pay. You do not know exactly the actual date because it's dependent upon the future outcome due to your past dealings, but coming to manifest in the future. For example, you supply something to a client is not happy with you, they take you to court, they sue you. Your lawyer tells you, maybe these cases usually cost between 50 and 80,000. Common sense tells you you're going to go with for a high amount. You recognize 80,000, but you do not know the exact date when the judge is going to do what to pass a judgment and the amount the judge is going to award this particular client. So it's a liability of uncertain amount and timing. That's what we refer to as a provision. For other liabilities, all right? For example, some of you have paid, of course, some of you have paid, part payment. Some of you have paid in full. So for those of you who have not paid in full, you owe me money here. And that's not a contingent, it's not a provision, no. It's a liability because you know exactly how much money you're owing. You know exactly how much money you're owing. You don't have to think twice about it. So for liabilities, you know exactly how much you're owing. You know when to pay it. For a provision, you don't know exactly how much because you're simply making a mere estimate. You're basing it on probabilities. So that's how it works, guys. That's how it works. All right, so there we go. Now, remember what we said earlier. We said there are three things we must know. So we're dealing with a provision. So we've talked about what a provision is about. What is a provision? Now let's go to the next, the recognition criteria. How do we recognize a provision? Okay. How do we recognize a provision? At what point do we recognize a provision? Mr. Gideon, please mute your speaker.
Okay.
Okay, fantastic. I'll just mute the speaker. So at what point do you recognize a provision? Now, a provision, we are going to do, of course, some probability tests later on, not now. There are three ways. Number one, recognize a provision only and only when an entity has a present obligation. If present obligation could be constructive or could be legal. We've discussed that. So when there's a present obligation, which could either be constructive or it could either be legal, then you can recognize a provision, right? See the next statement here. It's a present obligation to do what? Present obligation to transfer economic benefits. A provision should result in a transfer of economic benefits due to past events. It should not be something coming in the future. Like in the past, directors would create provisions for repairs and for fire. Fire is coming in the future. Fire has not yet happened yet. Go and use insurance, right? So it should be something coming from the past. It should be something coming from the past, but also it should be something resulting into a transfer of economic benefits. There should be some economic benefits being transferred from one entity to another. Recognize a provision when and only when it is probable that a transfer of economic benefits will be required to settle the liability. A provision cannot be recognized where there's going to be an injunction. No, forgive him. No, okay, I've forgiven you. No. If there will be no transfer of economic benefit, there's no provision. This is why we say it must be 50% and above chance that you lose the case. Because if you had 10%, it's not a provision. There must be some good measure of certainty, right? Yeah, okay. So there we go. Anything else? Yes, there is something else. Number 3, recognize a provision when and only when a reliable estimate can be made. There should be some sort of estimate, reliable estimate. How much would this cost us? You go to court. If you are sued, you ask your lawyer, dear lawyer, how much do you think it's going to cost? I don't know. What do you mean you don't know? You are a lawyer. You should know how much it's going to cost me. There should be a reliable estimate. By the word reliable, we mean don't get figures from your head. Use figures that are reliable. Either could be market values or it could be from your attorney. Sometimes the provision is in the exam, what the examiner likes where he says you entered into a lease for 20 years or whatever years it is, and then you've been asked by your landlord to take back the land into its original position at the time you'll be leaving. So because you're going to renovate the place when leaving, you're going to get a provision. Due to your past dealings, in the future, you have a provision. Or sometimes the examiner tells you about restructuring, dismantling costs, all those are provisions. And a lot of us in here know provisions because some of you are renting houses. While you're renting houses, the landlord tells you, can you pay security deposit? When you're leaving, we'll give it back to you. You have a contingent liability or a contingent asset. Okay, so there we go. So now we've talked about a provision. We've talked about the measurement of a provision. Now we want to ask ourselves the question. To ask ourselves the question, how do we report or measure a provision in our statements? Do we just wake up one day and discover the provision is about 10,000 kwacha, or what do we do? Guys, there are different ways of how you can measure a provision. All right? There are different ways. If you discover that the time value of money is material, then the provision should be the PV of the expenditure. And you've been doing this, it's the other class. It's the other class, not you. So now let's get into it. Let me give you an example here. Let me give you an example. Okay. It's the other class. We did the calculation on provisions. And guys, just so you know, today I'm sick. I think I have some, I don't know if it's malaria, I feel I have a little fever, and I have some flu, so I'm not leaving this place. So I'm just pushing myself right now because you guys are my bosses. Okay. So there we go. That's how come you've noticed that I'm not at my best. Yeah. So there we go, guys. So what we have here now At how much? How do you report a provision? No, the question I want us to answer is that how much do you report a provision at? Of course, the provision is an expense. All right, debit the expense account, and then credit the provision because it's a liability. Debit the expense account, of course, credit the provision. But what if, right? What if the provision is not cash, but maybe something that is to an asset or things like that? Sometimes it could be involving an asset, like I talked about a lease, dismantling costs and things like that. Simply debit the asset, credit the provision. Yeah. So the question therefore still comes, at how much should the provision be, measured? We can't answer that question because we have to understand two things. Is it a single provision? All right. Or is it a plural or one involving large population? Imagine if you are sued by one client, it's one issue, it's a different issue. If you are sued by 10 clients, that's another issue. Because one client you can sort them out quickly, but 10, 20 clients, that's a lot of money to pay. So if you're using a single provision, all you do just estimate, best possible estimate. Okay? You just wake up one day, you go to your lawyer, hey, dear lawyer, all right? My name is Charlotte. I have been sued by my landlord. What should I do? I was okay, fine, Charlotte, let's prepare for your provision. This case is likely to cost you so much. You make an estimate, you move on. That's a different issue. But where you have a larger population, this is the most common one in the exam. You have larger population, 20, 30 people are suing you. Or maybe, today I went to China Mall, just a few hours ago, I was at China Mall. I was buying some speakers. So I was given this, what is it? Okay. Yeah, I was given this document here. I was given this is the warrant. This is the warrant. They are saying that we are hereby giving you this warrant from on behalf of this same particular company. This warrant covers only electrical fault besides any other accidental or damages which may be caused by the misuse of the product is out of warrant. So this warrant, what this means, it means these speakers I bought today from China Mall, if at all they ever give me problems, electrical problems, I can take them back. If I drop the speakers, they break, I can't take them back. So warranties are provisions. So if you've been buying things, either a bed, a fridge, freezers, whatever it is that you bought in your house, you have a warrant. What you have there is a provision. Someone else has recognized a provision somewhere. In an event that there's a problem. So let's say you are a big shop like China Mall, for example, because I was at China Mall today. So like China Mall. What these big shops do, they look at the percentage of goods sold. Okay, they say, how many goods have we sold? Okay, excuse me. We have sold so much. What is the percentage of goods that have got no defects? They say, okay, we have 75% of goods, no defects. Ah, fantastic. 75% of goods have no defects. Oh, that's a good thing. Okay, then what is the percentage of goods with defects? They say 75% no defects. That means they were going to provide for zero amount of repairs. So you can see percentage of goods sold, defects, cost of repairs. What is the percentage of goods sold with minor defects? They say, okay, 20% of goods sold have minor defects. So what should you recognize for in terms of repairs? This can cost us maybe 1 million. They put there. What is the percentage of goods sold with major defects? 5% major defects. These are likely to cost us how much? 4 million. So this is what happens. So this paper was given today from China. If, for example, the speaker that I got, those guys that they know the percent of those goods which have no defects, they also know minor defects and they know major defects. So they have provided for a provision. If it happens that, for example, my speaker gets damaged within the time that I've been giving you on this warrant, it has an electrical problem, I can take it back. When I take it back, they're going to fix it at their cost. That cost has been accounted for. It could be either a minor, or under major. So what you do in the exam, if you have these kind of provisions, you must use expected values. All you do simply get 75% multiplied by 0 plus brackets 20% multiplied by 1 million plus brackets 5% multiplied by 4 million. What you're going to have is 400,000. That's how you work out a provision. So now you know this company is going to recognize a provision of how much? Of 400,000. They're going to debit the expense 400,000, and then they're going to create provision for with how much? 400,000. That's how these things work, guys. That's what happens in the exam. So that's the second way. The first way is simply an estimate. And usually the examiner tells you, especially in the audit, advanced audit, the examiner tells you this estimate. But sometimes you may be asked to work it out. The reason why I don't advise the students to do advanced audit before they do for advanced financial reporting is because the chances that they're going to fail are quite high. Audit is very deceiving. It feels very sweet when you're doing a self-study. You think you're understanding things. You go in the exam, and in the exam it's very straightforward. You like it. Yeah, it's straightforward. But when the results are out, you find you've got 20%, and then you're just shocked. It was so easy. It was so straightforward. Audit is never straightforward. It's never straightforward. And when you begin to feel, it's what I tell my students. If you're writing an audit exam, and then you begin to feel in your mind somewhere that is straightforward, it's general knowledge, stop writing, because you are failing that exam. Audit is never straightforward. The examiner of audit is a genius. It makes it look straightforward to the plain, so somebody with plain sight will not see what's behind. This is why you need to understand standards, because these standards are the ones that are going to help you understand or advise in audit. Okay. I don't know how to remove this thing which is coming. Okay, fine, it's gone. Yeah. Okay. So that's what works, guys. So this standard is highly examinable in audit. I keep mentioning this about audit because I'm telling you, some of you are doing audit. Some of these standards are very important for audit. One of them is this one. It's very important for audit. Extremely important. Because where there are problems with the auditing, there's both an audit risk, and at the same time, there's a business risk. An audit risk in that if this is wrongly accounted for, or maybe it's understated, or it could be either understated or overstated, it can pose an audit risk if the auditor does not spot that. And sometimes if you have too many people retaining things, or maybe too many so you may end up, yes. So what happens here is that in audit, extremely examinable standard, this one. So now there are sometimes, guys, where the time value of money is material. Sometimes the examiner wants to give you a standard, a provision like this one. The examiner would like to push you a little bit further. The examiner would like to give you this instead. This is what the examiner likes. To just test your understanding, to just squeeze you a little bit. The examiner would like to do something like this, to just come and push you to bend it up. And this is a very common one in the exam. And he brings this one together with leases. So where the effect of the time value of money is material, the provision should be the PV of the expenditure. The PV is simply the present value of the expenditure. What PV means, it means this. When you are taught to work out the PV, you are simply asked to say, how much could this be without interest? If you get a loan today from the bank of 10,000 kwacha, 10% interest, All right. It means in the future, you're going to pay 11,000 kwacha. So when you're asked to look at the PV, you're being asked to show the examiner how much would this money be if we paid now without interest. So you do the unwinding of the interest. So what we're trying to simply establish is which amount goes to the income statement, which amount goes to SFP. So SLPOC will, we'll see its operation after 5 years. This is the question. Let's say, let's write this one. Okay. So let's say SLPOC will cease its operations after 5 years. That's what the examiner is telling you. Like SLPOC is the company that's going to cease operations after 5 years. There's going to be cleanup costs then, right? Which will be how much? 5 million. So now, in the future, when SLP stops its operations, they're going to incur cleanup cost of 5 million. The examiner tells you the discount is 10%. Calculate the value of the provision. Guys, these things I'm showing you, your friends don't learn this somewhere. Please make sure you understand, because even at group accounts, you're going to be doing this thing. It's a very important calculation for this syllabus, the unwinding of the interest. Under group accounts, deferred payments, these are the things we do. If you can get it now, you're okay. So now, notice what we are being told. You've been told there will be cleanup costs after 5 years. If you understand dismantling costs, cleanup costs, this is a provision. So in 5 years' time, you're going to pay 5 million. So what the examiner expects of you is to show me how much this money is worth today. So common sense tells you, if you're going to pay this money after 5 years, why don't you allocate an amount to each year so that each year can incur an expense? Why don't you spread the cost over the period of 5 years? That's what the examiner wants you to show. If you're going to pay in 5 years' time, it will be too much to pay the whole amount in 1 year. So what is better is for you to keep allocating a provision every year. Each year, how much you're going to recognize. Each year, how much. Each year up to 5 years. So what you do, there are two ways of doing this. One way, come to the office straight. Come in, come in. The guy saw a visitor. He's coming from somewhere very far. Yeah. So what we have here, guys, the future value formula says future value is equal to PV 1 plus R to the power N. N is a positive N to show that you're going to the future. So instead of using the formula from the textbook, which I don't like, this one here, it's the textbook formula to work out the present value. So the future value, you have to make this the subject of the formula, and then you come and do what? The PV like this equal to future value over 1 plus R to the power N. I don't like that. So instead, we're going to use this guy here. I think I like this one more, because this one we simply adopt the same format. The only thing we change, we get this one comes here, the PV comes on the future value, and then the positive N, we turn it into negative N to show that we are now moving from the future to the present. So in this context, the examiner, there are two ways of how you can do this. You can either use the future value formula using this equation here, or you please take a seat, or you may either decide to use what we call the discount rate. So we're going to go through both of them. One way is this one. Let's use the future value formula. The future value formula is simply going to say, what is the present value? Present value is equal to future. What's the future value? Future value is how much? It's 5 million kwacha in the future. They're going to pay this money in the future. We put here on the future value. What's the interest rate? So we're going to say 1 plus R. Interest is how much? 10% to the power negative 5. So we're moving from the future to the present. So how much money are we going to pay now? Now you're going to pay 3,104,500 kwacha. This is the amount of money we're going to pay now, because we've discounted from the future to the present. Now, guys, This is just one way. The other way is this, where you use the discount factor. You simply say future value is 5 million. Then you say, what is the discount factor at 10% in 5 years? All right, so the discount factor at 10% in 5 years. Okay, every textbook has got the PV table. So you can go to the PV table. Here, at the end of every textbook, there's a PV table. Here. Okay, so you can go and check what's the discount factor at 10% in 5 years. So you're going to find a discount factor at 10% in 5 years. You're going to find it, actually it's that one. You're going to find the 0.62092. Then you multiply by 5, you're going to get how much? 3,104,600. It's the same one when you do this formula. So if you forget to use this formula, you can still use the discount factor. Discount factor is found where on the PV table here, right? So then you can do the discount factor of 5 to 10%. You get that one. Then you come and remove the interest. All you want to show is the interest. If in 5 years' time, you are going to pay 5 million, how much can you pay now? Now you can pay 3 million. The difference is the interest. That's what we are interested in, the interest. The figure is going to go to income statement. Yeah. So guys, that's you can give me 10 minutes up. Okay. So guys, that part you must understand. If you're not happy with that part, make sure you're happy because it's important. I'm showing you 2 ways of working out a provision using the discount factors, but also using the PV formula. So either ways, you can work it out. Okay. Assuming, so now here you can see that the difference is what we call the unwinding of the interest. The difference what goes to the income statement as interest for the year is what we call the unwinding of the interest. So you can see this is 3,600,000. If you want to, would have simply said this times how much? This times 10% is going to give you 3,014 or 3,015, like here. That becomes the interest for the year. Otherwise, it's the same thing. Okay. So make sure you're happy with that. All right, so guys, now we can go to something called deferred payment. We are going to talk more about deferred payment under group accounts a lot. When we go to group accounting, we talk more about deferred payments. All right. So now here, remember guys, we have talked about a provision. We are still on the first one here, the provision. We've done the calculations. We've done all the recognition criteria, the measurement. Now, what about a contingent asset and the contingent liabilities? What are these? All right, what are these? Now, I like to explain a contingent asset using this table here for contingencies. I think let's use this table because this table makes more sense for contingencies. Okay, let's talk about this one here, the probability test. Probability test. I'm sure you guys know what this is. If you don't know what it is, don't worry, we'll explain it to you. Now, there's a probability test. Let's say you are renting a house. All right. Like I said, a contingent liability is like between landlord and tenant. When you're a tenant, the landlord takes advantage of you. You know what the landlord does? The landlord tells you pay security deposit. If you leave the house the way you found it, I'm going to give this money back to you. But I can assure you, it's very rare to get back that money because the landlord always have something negative to find in that house when they're shifting. So a contingent asset is a possible asset whose occurrence or non-occurrence depend upon the future outcome. For example, pay me security deposit. If you don't break any window, you don't break anything, I'm going to give it back to you. In the similar sense, when you pay your landlord that security deposit, what you have is a possible asset, it's a contingent asset. Your landlord has a contingent liability because it depends upon the future outcome. So he's paying you back that money is dependent upon how well you're going to give that particular house. So when you pay a security deposit to landlord, you should understand that two things have happened. You have a possible asset, he has a possible liability. So what happens is this. How do you recognize that in your books? In your books, if there's a remote chance, all right, this is a probability test. Let's start with a liability. If there's a remote chance that you are going to have a contingent liability, do nothing in your books. If there's a remote chance that your landlord will give you back that particular asset, that particular deposit, do nothing in your books. Don't do nothing. What if there's a possibility? No, the word possibility in accounting is different. The word possibility means for 9% and below is a possibility. Below 50% is a possibility. Above 50% is a probability. It's probable. So a possibility, we don't do anything in our books. When there's a possibility, a possible chance that you're going to receive that particular money from your landlord, do nothing. Because it's just a possibility. Anything is possible. It can happen, it cannot happen. But for a liability, when there's a possibility you may have a liability, what do? You have to disclose. Tell the shareholders, you know what? There's a possibility we may be sued. Like I said earlier, Brenda tells Melinda, I'm going to sue you by Friday if you don't pay me my money. What Melinda has is a threat from Brenda, which is a possible liability. So Melinda is going to disclose to the shareholders, no, there's this lady who's threatening to sue us. Right? How about a probability? What is a probable chance that you're going to receive the money from your landlord? In that case, just disclose. No, there's a 50% chance that our landlord may give us back the security deposit we paid. Just disclose. Don't do anything because it's simply 50% chance. But for a liability where there's 50% chance that you're going to pay, you have to provide a provision. Make that estimate in accordance with the required IFRSs. So you only recognize an asset when it is virtually certain. When your landlord even comes to your house, inspects the house, he sees everything is okay. You've not messed up anything. The curtain, the window, whatever, everything is okay. The landlord is satisfied. And he tells, okay, fine, how do I transfer the money? In that case, then you can recognize what? An asset. You can provide now for what? You can provide for a particular asset. Because now it's virtually certain that you're going to get back, of course, your money. So guys, that's what happens under provisions. So a provision, contingent asset, contingent liabilities, not so serious, but these are important for audit, advanced audit, and also for this exam. It's a very examinable standard, guys, extremely important. Disclosures, of course, you have to disclose the amounts at the beginning of the period. What is the background to the particular provisions? What led the provision? Why are you even having this particular provision? What are the issues surrounding this provision? So you have to disclose all those kind of issues, right? Another issue that you can disclose, apart from the amounts that you are providing for, you may also want to disclose, of course, you may want to disclose maybe what was the provision at the beginning of the period. Did you have any opening provision? You may want to disclose such kind of stuff. You want to sort of have, a brief description of the nature of the particular contingent liability. You also may want to have an estimate of its financial effects on finances. You also may want to have to disclose an indication of the uncertainties that exist. Are there any uncertainties that exist? No, we've been sued, but it's not very clear if we're going to lose the case, if we're going to win the case, blah, blah, blah. We want to discuss that kind of thing. Is there a possibility of any reimbursement? You want to do that. You are at this level now, you are a director at this level. So, you should be able to think in those lines as a director. So I have an assignment for you for tonight. So for tonight, we end here. You're going to write a report to SLP or CCO, Mr. Chandrik Lusambo, explaining in detail 6 types of possible provisions. Okay, this is your assignment, guys. You're going to explain owner's contract. You're going to explain a restructuring. And then you're also going to explain these terms: use of a provision, changes in provisions, future operating losses, and reimbursements. Let me also add You also add on these terms, also explain the difference, of course, between contingent liability and contingent asset. Explain the difference between those. This is a report, guys. At this level, you're not able to write a report properly. Please do not type your assignment. I don't mark typed assignments. I want you to write in your own handwriting. Unless you are doing ACCA, do not type your assignments. Only ACCA students are allowed to type because for ACCA students, they do computer-based exams. For CA Zambia students, write it in your own handwriting because you do paper-based exams. Okay. There's a reason why I need you to do in that order. So guys, for tonight, we want to end here for today. It's been an amazing class. Unless there's a question, contribution, or just somebody wants to clap for me for being such a nice man. Yep. Yes, guys. Any contribution? Are you guys all right? Everything okay? Mr. Gideon, please mute your video. You want to switch your video off?
My video is off already.
Oh, okay. All right. Fantastic. Okay, guys, is there any question? Any contribution? Albertina, are you right? Mr. Chiland, everything okay? Yes, there's a question from Mr. Masheke. Mr. Masheke.
Sir, good evening.
Evening, thank you.
My question is, I've missed out on 90% of this lesson because of the challenges of network where I'm based. But then maybe my humble request also is that if you could find a way of me accessing whatever we've learned today so that I can also participate fully in the assignment and everything else. Thank you.
All right. So like we said at the start, we said that all those who are going to miss classes, I stream recordings on Saturday and Sunday. I don't send them to you because when I send recordings to you, you don't watch, just don't watch. So I want to stream to ensure people are watching so I can monitor you while I'm streaming. So we'll stream on Saturday and Sunday. Anybody else? Charlotte, everything okay? Are you all right? Charlotte, Melinda, Brenda, Mr. Mlenga, Albertina, Chofwe, Mr. Gideon, everything okay, guys?
Okay.
All right, fantastic. Okay, guys. Charlotte, can you hear me? Yeah, unmute, Charlotte.
Yes, I can hear you, sir. Just that it's heavily raining here, so.
Oh, it's heavily raining where you are. Okay, fantastic. All right. Okay, guys. So for tonight, we end here, guys. Have a fantastic night. I'm going to see you in our next class. All right. I'm going to say this is a very example topic, guys. Please go through. Make sure you're happy. All right. Make sure you're happy with this standard. It's extremely, extremely examinable. I cannot overemphasize the importance of this. Do the assignment. The assignment, I've put it in such a way that it's going to help you understand things I've not talked about better. So that we can come and review it together now, explain some of the things to you. What I've explained to you is extremely important and examinable. Please go through, make sure you're happy with this. Yeah. All right, guys, have a fantastic night. Have a good night, guys. I'm going to see you in our next session. For now, bye-bye.